Joining us here on set is Sunaina Sinha Haldea, the Global Head of Private Capital Advisory at Raymond James. It's so good to have you back here. I do want to start more broadly. I know you tend to be more focused on the private markets, but we do have equities that have been trading near record highs. There has been a fair amount of FOMO, at least up until today, in those markets. Your thoughts on what we're seeing across asset classes right now and what that's meant in terms of the push-pull of investor flows between public and private?
I think you're still in this market where any good news is bad news, as we've seen this week with PMI and jobless claims coming in better than expectations on both fronts, but that's bad news for the markets because of the expectation of a rate cut. But what we're seeing in terms of inflows into the markets, you have a market that was very cautious in early 23 up until the summer timeframe, where you had a lot of cash sitting in treasuries and you had a lot of cash sitting in short-term cash instruments. Now that cash is seeking opportunities to invest, and that's the big technical inflow you've been seeing in public and private markets in general. Private markets being much more constrained because of the lack of liquidity there, the lack of debt there, which is now improving, but has certainly been a constraint. So the publics have really benefited from that over the last 16 months or so.
I mean, one area where we've been arguably seeing outflows has been in real estate. And I say that even as Blackstone and even Ares have signaled maybe perhaps we're somewhere near a bottom for real estate. But you see what happened with B-REIT over the past year. I realize that's like stabilizing, or they've said it's stabilizing. But now even just today, Starwood REIT further limits redemptions to shore up liquidity. What does that tell us?
I think it tells us that there's questions about valuation of certain private market assets, in particular real estate. The Starwood REIT is very exposed to residential. And that market, as we all know, has taken a bit of a beating, especially as you think about a big supply side inflow into residential real estate coming up in the next 6 to 12 months or so. So that spurred a lot of redemptions, which is putting pressure on that structure. Now, you've got to remember, what is a private REIT? It's a semi-liquid structure. Investors that invest in it know going in that there will be liquidity gates, i.e. they can't redeem more than 5% of their investment at any given time. So they've gone into it with their eyes wide open. However, a big redemption request, as they've seen now, is going to put a lot of pressure on them. And they're looking to sell assets. They've got about $1 billion worth of property they have to offload very shortly here.
Sunaina, when you were with us back in March, you talked about how investors were watching the Reddit IPO to see if the window was going to open. We've had Reddit. It's done pretty well. We've had Rubrik as well. What's the mood?
Yeah, the mood is cautiously optimistic. Unlike at this time last year, I think there's more hope on the horizon for deal making and for capital markets windows opening. You're seeing term loan markets, the debt markets start to function again. You've got refinancings on the private market sides happening in the debt markets now very successfully. So now we're starting to see harbingers of perhaps that this is a good inkling as to when the rest of the capital markets open up for some of the other companies. But the quality bar remains incredibly high. The time of unprofitable, high multiples, that type of company getting a listing opportunity, those markets are gone. So it's high quality companies that have investor backing, like a Reddit, like some of the others we've seen. I think they stand a shot. But are the markets open in entirety? No, they're looking for a catalyst. And that catalyst everyone's been predicting is a rate cut. That rate cut looks elusive now. The chances of September rate cut just this week have gone below 40%. So we've got to assume September may likely not happen now. So then where are we with the rest of the year?
Any FOMO with risk appetites, perhaps stronger than many expected at this point, and maybe folks, private investors, some of them went too conservative?
Some of them went too conservative, and this is a great buying up opportunity, right? Where you've had markets being very quiet on the deal front for about 18 months now. One has to think that this can be a great vintage to invest and buy assets that have been relatively priced down here. Certainly, you've seen a big resurgence in take privates in particular in the UK market, for example, where there's a relative value arbitrage between the stock indices. So there are absolutely tailwinds here, and you've got to remember that private markets, especially private equity, works on a clock. 4 to 5 year investment period, 4 to 5 year exit period. That market's been very quiet in terms of new deal activity for about 18 months, but the clock doesn't stop, and so they've got to get out there and sell companies and buy more.